Okay, well, Matt Orton is now joining us. He's Chief Market Strategist at Raymond James Investment Management. Matt, good to have you with us here. Thank you very much. We have one more inflation print, and I'm not sure whether that conclusively leads us in one direction or the other. It's softened as expected, but many are pointing to the fact that the market is jumping ahead, as it has done many times in the past, by pricing out all rate hikes and pricing in a lot of rate cuts. Would you agree?
Good morning, Prashant. Great to see you again. And I would agree. I think the market is getting ahead of itself. We've had this conversation here for the past year where the market, like you'd mentioned before, gets very, very excited about a positive inflation print, only to realize that inflation, while it's softening, it's not softening enough for the Fed to say that mission has been accomplished. So today's CPI data has been the same thing. It came in as expected. But the fact of the matter is that inflation is still running at 2 times the level that the Fed needs it to be. And as a result, I think it does take a June hike off the table. But I certainly don't expect to see any rate cuts for the rest of 2023. And the market is pricing in probably 3 rate cuts by the end of 23. And unless there's a severe deterioration of economic data, which is not my base case, the Fed does not have scope to do that. And so I continue to tell our clients it makes sense to be more defensive in this market. You can have winning strategies by leaning into companies that are profitable, posting free cash flow, have earning stability, but you're more protected and not in some of those higher duration equities that I think would be most at risk should you have this sort of normalization play out, as I would think it will, as you head into the second half and back part of this year.
Matt, hi, good morning. So what would constitute a defensive stance when it comes to India? Would it be, say, financials here for you? Would it be just consumer stocks? How do you define your defensive stance for this market?
Hey, Survey, good to see you. And I think banks are a more defensive part of the market because we have seen, at least through earnings season, that ROE has continued to expand. The economy is on good footing in India, and so you don't have the same risk that you have in Europe or in the U.S. with respect to the banking sector. And financials and banks in particular have continued to do well in India, and so I think that area makes a lot of sense. And consumers as well, consumer staples and even some parts of consumer discretionary continue to be good. You look at some of the automobile manufacturers leveraged to growing trends in the consumer, whether it's electronic vehicles and that transformation, or factory vehicles like a Mahindra. I think those parts of the market can continue to do well. And I would say that's a little bit more defensive because you have profitable companies there as well. IT services, like we talked about last time, that's the one part of the Indian market that I'm still skeptical on. It's not an area I want to be bottom fishing, and that's not a place that I would say is defensive because it is levered to, I'd say, the most at-risk slowing parts of the global economy.
Hi, Matt. Morning. You've mentioned in the past you like Asia ex-China, but what's the view on China from here on? That was the market that rebounded big time from November, October end till around, April odd. But that seems to, data points we're getting out of there is mixed, and that could have repercussions on the rest of the globe as well. How are you reading that?
Yeah, it's a good point, Nigel. And I think China, it's an area that, even though the reopening is continuing to go as planned, I think the 2 biggest challenges for China right now is number one, concentration. So a lot of the Chinese equity market is concentrated in mega cap internet communication services companies, and that is a risk for the Chinese market as a whole, because a lot of those names have become very, very expensive, and they are levered to, I'd say, some of the global growth themes that might be starting to slow down a little bit. So if you're going to play China, you want to be more exposed to, I'd say, consistent areas of government spending and expansion. So industrial, cement type companies, consumer staple type companies. I think those are the ones that are going to perform the best. But the other part of China that I think is a little more concerning is, have we plateaued with respect to the amount that consumers are going to spend? I think we still need to see a lot of that play out and how people's spending habits, travel habits may have evolved even with the zero COVID reopening and reversal. So I'm still waiting to see, and that's why Asia ex China, I think, makes a lot of sense, because you get the tailwinds of China reopening, but a lot of those countries still have growing middle classes. The countries have less debt, and they have diversified economies without that sort of concentration risk. So I like those areas as well. And areas like Taiwan, South Korea have exposure to the AI upcycle, but also have diversified financial sectors as well that can be on the upswing.
Okay, got that. Matt, good talking to you as always. Thank you for stopping by. Slightly shorter chat today, a little tight on time, but really appreciate it. You have a great day, and we look forward to the next one. Well, with that, we will take a very quick break, and we'll come back with a lot more on the other side. In fact, our entire team is standing by with the CNBC-TV18 list of top stocks to watch out for. So keep it with us. Back in just a moment.